How are you today? You have rat test tomorrow, you remember? Okay. Okay, attention please. Your attention please. Backlines, can you hear me? Okay, beautiful. So last week we saw how to reformulate the balance sheet and the income statement. Today we continue and see how to reformulate the statement of cash flow. Actually, we already discussed this one in the past, if you still remember, in lecture 3 when we discussed the dividend discount model and the free cash flow discount model. We just need to add little extra adjustments. Let us see how to do that. Remember that the key idea is to isolate operating activities from financing activities. First, let us introduce some important relations or equations. Remember that the free cash flow can be calculated as the difference between operating income and the change in net operating income. This equation is called the sources of cash flow equation. There is another equation, is the disposition of cash flow. According to this equation, the free cash flow is equal to net financial expense minus the change in net financial obligations plus D. Note that these two together is just F. These two together is the F. You remember F? F is lending minus interest received minus borrowing plus interest paid. Remember? When we calculate F, I told you that lending under F is just the change in financial assets, and borrowing is the change in financial obligations. When we combine them together, the change in financial assets and the change in financial obligations, we get the change in NFO. Okay? Okay. Alternatively, if the firm has net financial assets, the equation looks like this. So these two together is the F. This is the case when the firm has net financial assets and net financial income instead of net financial obligations and net financial expense. So these are the equations that can be used to calculate the free cash flow using what? Look at these items. Look at these items. Operating income can be taken from the income statement, right? The change in net operating assets can be taken from the balance sheet. Again, this one from the income statement, this is from the balance sheet, right? And this one, although we need the statement of cash flow, but D also can be calculated from the balance sheet by reconciling the cash, the dividend declared against the dividend change in dividends payable. You remember the equation? Okay. So we can use the income statement and the balance sheet to calculate the free cash flow using one of these equations. Alternatively, we can go straight forward to the statement of cash flow and calculate the free cash flow after reformulating the statement. Let us see, however, that the two methods using this one or one of these equations need not give us the same answer for the free cash flow for many reasons. We will discuss them shortly. Let us see the calculation of the free cash flow according to method 1 and method 2. So free cash flow is equal to operating income minus the change in net operating assets. In 2010, the operating income of Nike was 1814. This is the adjusted or reformulated operating income. In that year also, the firm had net operating assets of 5514, and in 2009, the net operating assets was 6346. Taking the change, this minus this gives us this. Now this minus a negative number, it means that we need to add the absolute value of this one to this one. So this is the free cash flow, C minus I. And that is equal to operating income minus the change in net operating assets. Okay? We can arrive at the same number by using this equation. We take the change in net financial assets. This is the financial assets in this year, and this is the financial assets in 2009. We take the change, so this is the change, and this is the net dividend, D here. Note that in this year, although the firm in 2010 had net financial assets, nevertheless the firm ended paying net financial or had net financial expense. So this is net financial expense, not rather than net financial income. So in this case, we add the expense rather than we subtract it. If this one was an income, we subtract it because this is what the equation says. Because it is an expense, we add it. Okay? As you can see, we got the same answer here. We got the same answer. Right? Okay. The third method is to reformulate the statement of cash flow and calculate the free cash flow. This is the statement of cash flow for Nike over 3 years. Remember that the statement needs to be reformulated. We cannot take it as given. For many reasons, there are many problems in the statement. The first one is that remember the equation here. We need to calculate the cash from operation and cash used in investing activity in order to calculate C minus I. We need also to calculate D plus F. And the change in cash and cash equivalents should be allocated between these items and these items, as we shall see shortly. So change in operating cash should be included in the investment section, and the change in cash equivalents in the financing section. Okay? The change. Normally, most of the time, you will see that cash and cash equivalents are lumped together, combined together. In this case, you can use the rule of thumb we discussed last week. You can estimate the operating cash as 0.5% of sales. This is fine. So you calculate the operating cash in 2000, for example, for 2 consecutive years as 0.5% of sales in this year and 0.5% of sales last year. Then take the change and include it under I. Then you calculate the cash equivalents as the difference between cash and cash equivalents and the operating cash for the 2 years, and take the change and include the change in cash equivalents under the financing section under F. Make sense? Okay. Remember also that some financial assets are included in the investment section. These are the net purchase of debt securities. Remember? These ones should be excluded from the calculation of I because they are financing activities, right? They should be included under the calculation of F. You remember when we discussed lecture 3, we saw that firms in practice they include their investment in debt securities under the calculation of I. And we said that these are financing activities and should be excluded. Interest payments and receipts are also included in the operating, so we should add the net interest expense after tax, net interest paid, sorry, after tax, we add it back, or if it was a net interest received, we subtract. Okay? We handled this one in the past, we handled this one. And also the tax should be allocated. So the new points or problems is this one and this one. This one can be ignored. So this is the new point to be discussed here. So this is how we do it. The change in cash and cash equivalents from 2010 to 2009 or 2009 to 2010. This is the change. We calculate the change in operating cash over 2 consecutive years. For example, here, we go to the sales, operating cash, operating cash, operating cash in 2010, 2009. We calculate it as 0.5% of sales. And the same applies here, 0.5% of sales. We calculate the operating cash over 2 consecutive years. Then we take the change and we include this change. This is the change. We can round it to 1 million. We include this change in the investment section under I. Okay? Then we calculate the cash equivalents over these 2 years. In this year, in 2010, it is the difference between cash and cash equivalents and the operating cash. That will give us the cash equivalents. Make sense? Okay? So here, in this year, in 2010, it is cash and cash equivalents minus operating cash. Okay? The same here. It is cash and cash equivalents minus operating cash. Make sense? Make sense? And then we take the change. Once we have calculated the cash equivalents for each year, we take the change. This is the change. The change, not on financial assets, it is better to put the change in cash equivalents to be more accurate. Okay? Make sense? Any problems? Any problems, any questions? Okay. Once we have done that, we handle the second problem, and that one is to exclude the financial securities bought or sold by the firm. We should exclude them from the calculation of I. We did that in lecture 3 for Nike. This is another example for another company called Lucent Technologies. This is another example. As we can see, this is the reported I. This is the reported I. We go through the components and see if there is any item that doesn't belong to the calculation of I. Capital expenditures, yes. Proceeds from sale of property, plant, and equipment, okay. Purchases of equity investment, okay. Sales of equity investment, okay. Remember, equity investment in other firms is a cash investment in the operations of other firms. So we keep it in the calculation of I. Okay? Purchases of investment security, no. These ones usually are debt securities. Sales or maturity of investment securities, no. Dispositions of business, yes. Acquisitions of businesses, yes. Cash from mergers, yes. Other, okay. So these are the 2 items we need to exclude, and this is the net cash from them. These 2 items, and this is the net cash. So we take the reported investment minus the net proceeds from the sale of financial assets, and that is the adjusted I. So this is the adjusted I, equal to this minus this one. Okay? Make sense? Alternatively, you can sum all of these items excluding these two. You will get the same answer. Okay? You will get the same answer. Just sum all of these items excluding these two, and you will get the same answer. Okay? It looks very dark. Is it better like this? Okay. Any questions, any problems? No? Okay. We need also to handle the net cash interest or net interest paid or received along with the tax treatment. Remember that we need to calculate the after-tax net interest paid or received. We add back the net interest paid, we subtract the net interest received. You remember why? So this is the interest received, and this is the interest paid. So we have net interest paid. And this is the tax benefit. This minus this gives us the after-tax net interest paid. Again, I would like to refresh your memory. When we calculate C, we start with net income, and then we add non-cash charges or expenses, and then we take the change in current assets and the change in current liabilities. You remember? You remember? I told you net income is EBIT minus interest minus tax, right? Because interest was originally subtracted from net income, assuming there was net interest expense here. Then we need to add it back to the reported C on cash basis in order to isolate its effect, because it is a financial item. It was originally subtracted to arrive to C, so we need to add it back. Okay? That will give us the cash from operations after excluding the effect of the financial items. Here it is the net interest expense. If it was net interest income, we subtract. Of course, again, we are talking here on cash basis, not on accrual basis. In the statement of cash flow, you will find a footnote for the interest paid and interest received. If you cannot find it, then it's okay to use the interest expense and the interest income as an approximation to the interest received or paid. Okay? You can calculate the interest paid and interest received by taking the interest income, for example. Take the interest income minus or plus the change in the interest receivable, if it is available in the balance sheet. And the same applies to the interest expense, plus or minus the change in interest payable. It depends. Okay? Okay. So this amount needs to be added because it is a net interest paid. There are non-cash transactions. These are non-cash transactions, and they will not affect the calculation of C in the statement of cash flow, but they will affect the calculation of the free cash flow according to method 1 and 2. For example, remember under method 1, C minus I is equal to operating income minus the change in net operating assets, right? Many of these transactions will be included in the calculations of net operating assets, right? Right? Make sense? So they will affect the calculation of the free cash flow according to method 1 or 2, but not according to the third method when we use the statement of cash flow. So remember, when we reformulate the statement of cash flow, we should reformulate it in a very neat way according to the cash conservation equation, such that C minus I is equal to D plus F. Okay? You are familiar with this equation. So this is how we do it for our beloved company, Nike. So this is the reported C. This is the reported C. We add back the after-tax net interest paid. So this gives us the adjusted C. So this is C star adjusted, the adjusted cash flow from operations. You remember this figure? You remember? Okay. Now we need to calculate I. We take the reported I. We exclude the net investment in financial assets because it is a financial or financing item. So we need to remove it. And we need also to report it under the calculation of F. So these together, they give us F. So here we report it. It is here. This is where we report it. So we exclude this net purchase from the calculation of I, and we report it under F. Make sense? And also the change in operating cash should be, this is the change or investment in operating cash. Investment in something is equal to the change. So investment in operating cash is the same as the change in operating cash. You remember we said, okay, we can round it to 1. So this is 1. You remember? You remember the change in operating cash and change in cash equivalents? So this is the adjusted I. This plus this minus this gives us this. So this is I star. C star minus I star gives us the free cash flow star, or the adjusted free cash flow. Okay? That is the same as C minus I. C star minus I star. Okay? Remember that there is also the change in cash equivalents. It is reported here. Remember, this is the change. This is the investment in cash equivalents, or the change in cash equivalents. 835, if you go back to the formal slide, we estimated the change. The estimated change in cash equivalents was 787. So the difference is because the author combined this change in cash equivalents with another figure. He combined that figure with something called effect of exchange rate changes, 47.5. So this figure is 787. This is the change in cash equivalents plus 47.5. This is the effect of, this is the change in cash equivalents, and this is the effect of exchange rate changes. You can report each one separate from the other. It's okay. You can combine them together because this amount is small. It's okay. It's not a big issue. If you report this one separate from this one, that's fine. It's not a big deal. Okay? As you can see, when we calculate F, these items are very clear to us. The decrease in notes payable. Normally, notes payable, most of the time, they are financial assets, financial liabilities. And so the change should be included in the calculation of F. We have here reduction in long-term debt. Again, it is a financial liability, and the change should be calculated or classified or reported under F. This one, we know what this one is, and we know. And note something, this is the net interest paid after tax. It is removed from here and it is reported here. See? This is the net interest paid after tax. So we add it back to the reported C, and we report it where it's supposed to be. We report it under the calculation of F because it belongs there. It doesn't belong to the calculation of C. Okay? Make sense? Remember, F is equal to what? Again, lending minus interest received minus debt raised plus interest paid. So interest received and interest paid, the net between them is this one, net interest paid. Okay? So this is where it should be reported under F rather than under C. We add it back because it was originally subtracted from the net income to calculate C. So we add it back. Make sense? These are the transactions that represent D. So this is F, this is D. As we can see, the sum, this plus this is the sum. This is F plus D. It is equal to C minus I. So this is C minus I, or the free cash flow, and this is F plus D. The two sides are equal. Make sense? This one is equal to this one. C minus I is equal to F plus D. Any questions? And if you have any problem, please ask me. Don't hesitate to ask. Just ask. We have a lot of time. The lecture is very short, and we can explain everything thoroughly. So please ask me. Okay, up to you. As you can see, this number 283.6 is not the same number obtained under method 1 and 2. If you go to method 1 and 2, the calculated free cash flow there, was 2646. If you go to method 1 and 2, the calculated free cash flow was 2646, but here it is 2836. Right? The difference, of course, was because under method 1 and 2, we calculate the free cash flow using items in the income statement and the balance sheets, which are usually calculated according to the accrual-based accounting. Okay? Accrual-based accounting. And also because some items there are also hard to classify as operating or financing. For example, other assets and other liabilities are not identified as either operating or financing. Cash dividends in the cash flow statement differ from dividends in the equity statement. Remember, under the cash flow statement, the dividend reported there is cash. But in the equity section of the balance sheet, dividends reported there is calculated according to the accrual-based accounting. To calculate the cash dividends, we need to reconcile it against the dividend payable, the change in dividends payable. Right? If dividends payable is not available to us, then we use the reported dividend, and that will be different from cash dividend here. Make sense? Cash from share issues in the cash flow statement may differ from share issues in the equity statement. Again, this is actual cash raised when the shares were issued. But here in the equity statement, we may issue, the firm will report the value of these shares, although some of the proceeds haven't been received from the shareholders till now. Okay? For example, some shareholders may buy shares, but the firm hasn't received the cash yet. But the firm in this case will recognize the value of these shares in the equity statement, although still the firm is receiving, or still yet the firm hasn't received the cash, the full amount or value of the shares from the shareholders, okay? So we have differences here. Sometimes also the details for adjustments 3, 4, and 5 are not always available. Remember 3 and 4 and 5. 3 and 4, when we calculate the net interest paid and the tax treatment, and 5 is the non-cash transactions. Non-cash transactions. So sometimes we do not have enough details. If you still remember, when we tried to calculate the net interest paid for Nike, we have the interest received, but we do not have, the interest paid, but we didn't have the interest received. So we used interest income as a proxy, as an approximation to the interest received. You remember? Yeah. Also, the accounting treatment of employee stock options, if you still remember, there, the loss from the exercise of these options, if you go, you remember this lovely figure, 58.5. This is the tax benefit from exercising option incentives. You remember last lecture number 5, when we dealt with the hidden dirty surplus, the loss from exercise of options. This amount was the tax benefit from the loss arise because of the options exercised. So this loss is recognized or reported in the cash flow statement, but it didn't appear in the income statement or even the balance sheet. It didn't appear.
It includes the balance sheet loss.
Sorry?
Balance sheet loss. Under the
Balance sheet what?
loss.
Notes?
Yeah. Loss.
Notes?
Yeah. Just to show that what's the information.
Yeah. If you find it in the balance sheet notes, yes, you can take this one into consideration. But remember, in the balance sheet, in the equity section, we noticed that something called employee stock compensations, and that was an expense. This expense was originally, it was debit employees' expenses in the income statement, credit equity in the balance sheet. Okay? And that was calculated according to the grant date accounting. So it wasn't an actual loss or cash loss. This amount was amortization of the initial values of these options over the vesting period. It wasn't an actual loss. You remember? But this figure is an actual loss. This is an actual loss when the options were exercised. Make sense? Sometimes also because of the foreign subsidiaries and the way the balance sheet and cash flows of the overseas subsidiaries are translated to the home currency. We will discuss this topic in the last lecture. Sometimes some cash flows from investment activities are classified as cash flow from operations. For example, R&D expenditures, usually these expenditures are expensed, so they affect C. They affect the calculation of C. The same applies to the investment in inventories. Investment in inventories means the change in inventory, okay? The investment in any asset is equal to the change in that asset. For example, the investment of property, plant, and equipment in any year is just take the change from this year relative to last year. That will give you the addition to these assets, okay? Again, the change in inventory affects the calculation of C, although for some firms, the two items, this one and this one, For some firms, the two items should be included in the calculation of I. Okay? For example, think about car dealers. What is the most important investment from the perspective of the car dealers? Is it the cars, their inventory of cars, or the showroom, the warehouse? Which one is more important, the inventory or the warehouse? The warehouse or the showroom? It is the cars, the inventory of cars. This is the most important. This is the source of value. From the perspective, think about, for example, Woolworth. What is the most important for them? The inventory inside or the store? The inventory. So this is the most important investment for them. So it depends from one firm to another. The nature of investment differs from one firm to another or from one industry to another. Okay? For some firms, the change in inventory maybe is the most important investment and should be included in the calculation of I. However, when you calculate the free cash flow, it doesn't matter if you report these under C or I. For example, why is that? Because, for example, because this one was expensed, it means it initially reduced C. So if you add back, for example, 3 and add 3 to I, when you take the difference remains the same. So it doesn't matter. It doesn't affect the calculation of the free cash flow. Okay? This misclassification doesn't affect the calculation of the free cash flow. Okay? So it is not a big deal when you use the free cash flow to valuation. When you use the free cash flow in the valuation, any misclassification is not a big deal. Okay? Note that the cash flow from operations can be always used to evaluate the quality of earnings. And we can evaluate the quality of earnings by looking at the difference between the operating cash flows and the reported earnings. The bigger the difference, the lower the quality of earnings. The difference is usually called what? What do we call the difference? Accruals. You remember? The difference between the operating cash flows or cash from operations and, remember, cash from operations is the same as operating cash flow. It is the same. Cash from operations or operating cash flows, all are the same. So cash from operations minus earnings gives us the accruals. Okay? So the bigger the amount of the accruals, the lower the quality of earnings. Okay? However, manipulations in the financial statements usually are made to the accruals, although the cash flow from operations can be affected by the firm. So the firm can do some transactions that will influence the amount of the cash flow from operations, but still at the end of the day it is a cash figure. It is a cash figure. For example, firms can delay payments to generate cash flow. Firms can sell receivables to generate cash flows. All these transactions, they affect the cash flow. Okay? All of these transactions, they do affect the cash flow from operations. But at the end of the day, the reported figure is a real figure. It is a cash amount. And the difference between this figure and the reported earnings is equal to accruals. And so we are going now, in the second part of the lecture, we are going to see how to evaluate the quality of the earnings and financial statements. Okay? Okay, let us take a break.
minutes or 10 minutes? 5? 7 minutes. Half the way. 7 minutes. Half of the way. 7 minutes.
Okay, let us continue, please. Let us continue. So let us evaluate the quality of the financial statements. This is a very broad topic, chapter 18. And if you want to read, this is a very important point. If you want to read from the textbook, just focus on the topics I covered during the lecture. You do not have to read everything. Just the topics I covered during the lecture are examinable, okay? It is a very broad topic, but I did my best to simplify it as much as possible. In practice, do not assume that accountants are angels. They do, firms and their accountants, they do try to manipulate the financial reports in order to make the financial statements look very nice and the firm is doing very well, blah, blah, blah. Normally, the ultimate objective is to manipulate the earnings. This is the bottom line, right? And usually, in practice, firms, they try either to borrow income from the future in order to inflate current earnings, or to push income from the present to the future. Okay? Normally, this kind of manipulation leaves a trail. There is no complete crime, huh? There is always a trail. Okay. Why is that? Because of the reversal property of accounting. Earnings induced by accounting methods always reverse in the future. Think about expenses that are capitalized. For example, assume that the firm capitalized a lot of repair and maintenance expenses. Capitalizing these expenses means that the firm is adding these expenses to the fixed assets rather than treating them as an expense. Okay? Okay, that will improve or will let us say, evade some expenses for this year and will improve earnings. But when we add them to the fixed assets, that will increase the future depreciation. So that will reduce the future earnings. Okay? So this is the meaning of reversal property. The same applies, for example, if we claim a lot of deferred revenues. You remember the meaning of deferred revenues? Deferred revenues are usually unearned revenues. They are a liability to the firm. This is the case when the firm receives advance payments from customers in order to deliver goods and services in the future. The firm should claim as revenues only that part that have been delivered to the customers. But if the firm, for example, claimed the full amount, okay, that will increase revenues for this year, but it will reduce revenues in the future, right? So there is always a trail. There is always a reversal to manipulations, okay? Manipulation that inflates current income is referred to as borrowing income from the future or aggressive accounting. Manipulation that reduces current income in order to inflate the future income is called big bath accounting. When you evaluate the quality of the financial statements, ask the following questions and try to find an answer to these questions. Is GAAP accounting deficient? Is the firm violating the gaps? Is the firm using GAAP accounting to manipulate reports? Evaluate the transaction quality, for example. Is the firm manipulating business to accommodate the accounting in terms of timing, in terms of the structure? And also evaluate the quality of disclosure. Disclosure means the details that comes with the financial statements. The greater the details, the better the quality of the reports, right? Low disclosure or little disclosure is not good. It's not very informative. Okay? We need enough disclosure in order to see and be able to properly identify each item. Now let us have a look at the trail. Remember that operating income is the free cash flow plus the change in net operating assets. Okay? We just rearrange the formula. Remember the formula says C minus I is equal to operating income minus the change in net operating assets. Just rearrange the formula for the operating income. Okay? And you get this one. Remember that C minus I is a true and real cash figure. So this one cannot be manipulated in order to improve the operating income. It can be affected to increase or reduce the cash, but it cannot be manipulated to affect the income. So if there is any manipulation to the operating income, usually the manipulation is found here under the change in net operating assets. Okay? The change in net operating assets is equal to net operating assets at time t minus net operating assets at time t minus 1. Usually, the manipulation is contemporary. So if there is a manipulation to operating income at time t, this manipulation will be associated with an increase or decrease to net operating assets at time t. So if we increase operating income by an amount, there will be a similar increase to the net operating income at that time. If we decrease this one, we have a decrease here. Okay? A further trail is to rearrange this formula for the change in net operating assets. So just rearrange this formula. You get this one. Operating accrual is just C operating income minus C. Okay? Operating accruals is the operating income minus C. Just rearrange this formula for the change in net operating assets. So again, remember, I is hard to manipulate the miss can be found in the accruals. Let us see how to the effect of this manipulation. Remember, last week we discussed some ratios, and one of them was the return on net operating assets, and I highlighted this ratio. I told you this ratio is very important. Remember that the return on net operating assets is the operating income at time t, of course, on after-tax basis, divided by net operating assets at time t minus 1. So return on net operating assets at time t is equal to operating income at time t on after-tax basis divided by the net operating assets at time t minus 1. Assume that the firm decided to inflate unfairly, to inflate the current operating income. In this case, any increase in the current operating income at time 0 will be associated with a similar increase in the current net operating assets. Right? I told you that the free cash flow here, C minus I, is a hard figure. It is a real cash. So if there is any manipulation to the operating income, it will be associated with a manipulation in the contemporary net operating assets. So if the firm inflates the current operating income by 1,000, let us say up, inflated means exaggerated the number or increase the number unfairly, that will be associated with a similar increase in the contemporary net operating assets. Now let us see the effect on the future return on net operating assets. Next year, return on net operating assets next year is equal to what? Is equal to operating income for the next year divided by this year net operating assets. So if there was an inflation in the operating income for this year, in order to boost the current return on net operating assets, that will reduce next year return on net operating assets. Why is that? Because of two effects. The first one is the numerator effect. Inflating current operating income will reduce next year's operating income because of the reversal property. Because of the reversal property. And remember that inflating current income will be associated with an inflation in the net operating assets at time 0, contemporary. So because this one is used in the calculation of the next year return on net operating assets, so inflating this one up, and when this one goes down, then the ratio is down. So we have a numerator effect and denominator effect. Make sense? Make sense? Okay. So the ratio will go down if there was a manipulation in this year. Next year, the ratio will be lower than this year, this year's ratio, because of the two effects. The numerator effect, this is the reversal property, and the denominator effect because of the inflation happened to this year's net operating assets. Okay? As you can see, when you evaluate the quality of the financial statements, please distinguish between these two types of accounting policies and these two types of manipulations. Remember that conservative accounting and liberal accounting, these are accounting policies, whereas these types are types of manipulation. So you need to be careful when you evaluate the quality. Make sure make sure that what you find is a manipulation rather than an accounting policy. Okay? For example, if you find a firm, for example, claiming a lot of the unearned revenue as revenues for this year unfairly, this is a manipulation. But if you find a firm, for example, that doesn't recognize revenue until it is really earned, this is an accounting policy, conservative accounting. Okay? Okay. So let us see the balance sheet items that are usually manipulated by accountants, and of course they do affect the earnings of the firm as well as its revenues. Gross receivables can be manipulated if, for example, when the accountants book revenue in advance of their being earned. That will inflate the gross receivables as well as the revenues. And any inflation to the revenues, of course, will inflate the earnings, right? Right? Net receivables can be also manipulated by manipulating or decreasing the allowance for bad debt, right? And decreasing the allowance for bad debt, this also will be associated with lower bad debt expense, right? And that will, of course, inflate earnings, right? Lease receivables, for example, by decreasing the estimated residual value on lease termination. This will inflate the lease payments. Inventories, for example, by booking non-inventory cost to inventory. And also failure to write down obsolete inventories. Of course, that will lower the cost of goods sold, right? I saw something like this in my professional life. There was a company, a guy, a financial manager of a company. He came to the bank in which I was working. I was the chief credit analyst back then in that bank. And he gave me financial statements. The company was like specialized in raising little chicks, little chicken chicks, you know. Okay, I saw that inventory in their balance sheet was very sizable. Most of the assets were inventory. I told them, okay, you have finished goods. Okay, what the finished goods are? He said, these are the little chicks. Okay. I told him, okay. What about the work in progress? He said, this is the cost of the grains we used to feed to the little chicks. I told him, you should have expensed these items because they are eaten. We're eaten by the little chicks. You do not have this inventory. If you have inventory for grain inside your warehouses, okay, that's fine. They do have inventory for grains, that's fine. They also recognize this one. But to claim the grain that had been already eaten by the little chicks, to claim it as a work in progress, that doesn't make sense. Because to claim it as an inventory, it means that you can liquidate it and convert it into cash anytime. But can we liquidate the eaten grains? You know what will happen to the grains after they are digested by the little chicks. In and out. They are not convertible into cash. I told you can't do that. So this is one of the, as you can see, this is one of the manipulations. You need to be careful. Okay? Work in progress. Amazing. Prepaid expenses by, for example, overestimating the amount of expenses prepaid. Firms, sometimes they do have an expense, but instead of recognizing the expense in the income statement, they add it to the prepaid expense. as an asset. That is not fair. Book repairs and maintenance to property, plant, and equipment. That will reduce this year's expenses, but it will increase next year's inflation. Alternatively, firms can reduce future inflation. Reduce. This one will improve earnings for this year, but it will increase not inflation, depreciation for next year. I'm sorry, depreciation. Alternatively, firms can increase the estimated useful lives of their fixed assets or the residual values or salvage value, and that, for example, when we do that, when we extend the useful lives of our fixed assets, that will reduce future depreciation charges. That is not fair, right? And I saw also an example of such a case a couple of years ago. I asked my master's students to value Telstra. That was their assignment. I teach a similar unit to the master's students, but at higher level. And what happened is that for 2 consecutive years, sales of Telstra were almost the same. Little change in the revenues for 2015 and 16, or 14 to 15. Little change in the revenues, almost the same. But there was an increase, a sizable increase. There was a sizable increase in the cost of goods sold. And therefore, the gross margin, the gross profit was reduced, lower. However, when you look at the bottom line on earnings and the earning per share, the change, there was almost no change in the earnings and the earning per share, almost the same. How come? When we dig deep, when we investigated the matter, we found that Telstra that year, in order to improve the earnings or to keep the earnings almost similar to last year's level, they extended the useful lives of their fixed assets in order to reduce the amount of depreciation charges. That was a real life example. Okay? So you need to be careful when you value these statements. Intangible assets, like when we charge inappropriate expenses to intangible assets, and also deferred charges. This is the case when we also classify some current expenses as deferred expenses. In the liabilities sides, also deferred revenues could be manipulated by reducing the deferred revenues in order to boost this year's revenues. Warranty liabilities also could be reduced in order to lower the associated expense. The same applies to accrued expenses, pension liabilities, and unpaid claim reserves. So these are the items that could be used by accountants in order to manipulate the statements and improve earnings. So when you evaluate, make sure, when you evaluate the quality of the financial statements, make sure that you understand the business. This is the first step. Always compare the items that could be manipulated with peers in the same industry. For example, if you are evaluating the quality of the statements of a firm, look at the allowance for bad debt. Compare it with its peers in the industry and see whether your firm is equal to others or below or above. Okay? If it is lower, if the bad debt rates is lower than other firms, this is a bad signal. It means that the firm is trying to improve its earnings by reducing the allowance for bad debts. Okay? For example, the same applies to the useful lives of assets. Look at the useful lives of other firms in the useful lives of the fixed assets for other firms in the same industry. Compare it with your firm and make sure that they are almost the same. If there is a significant difference, this might be a signal that this firm is trying to manipulate the reports. Okay? Also, areas where accounting quality is most doubtful, we already discussed them. the areas on the income in the balance sheet, and also situations in which management are usually tempted to manipulate. Normally, this is the case when the bonuses of management are linked to earnings. And also I saw something like this during my professional career. The manager of the bank in which I used to work, he was entitled to a 1% bonus, 1% of earnings. His bonus, he was entitled to a bonus equal to 1% of earnings every year. So this guy was trying his best always to minimize the expenses as much as possible in order to increase his bonus value as a percentage of earnings. So you need to be careful. Flashpoints, accounting areas where manipulation is more likely in each industry. In the banking industry, pay a special attention to provisions for loan losses. Computer hardware industry, pay attention to the quality of deferred revenues and warranty liabilities. In the computer software, look at the capitalized research and development and also the way the revenues are recognized. In the retailing, pay attention to the quality of net accounts receivable and also inventory, the quality of the inventory, whether it is obsolete or not, and the quality of the carrying value of inventory. In the manufacturing industry, pay attention to warranty liabilities and the quality of estimated liabilities. In the car manufacturing industries, pay attention to the depreciation allowances because these firms are usually capital intensive, so they have a lot of depreciation charges. So it is in their best interest to minimize this substantial expense. Telecommunication company, again, pay attention to the depreciation allowance. Equipment leasing, the carrying value and the residual value. Tobacco, pay attention to the estimated liabilities. Pharmaceuticals, pay attention to R&D and the quality of the estimated liabilities. Real estate, again, the carrying value. Make sure that the properties held by this firm, they really reflect the current market value rather than inflated figures. In the aircraft and ship manufacturing, there is program accounting and percentage of completion method. Make sure that they are not using these kinds of accounting in order to manipulate the revenues figure. Subscriber services, the quality of capitalized promotion costs and the quality of deferred revenues. There are also, in addition to these accounting areas, there are also institutional situations where manipulation is more likely. For example, when the firm is in the process of raising capital or negotiating borrowing. In this case, the firm may try to manipulate the reports in order to raise capital at competitive terms. Okay? Debt covenants. Debt covenants are the terms and conditions that are usually imposed by lenders. For example, if a firm obtained loans from banks, banks usually they impose covenants on the firm or terms and conditions. For example, the bank may require the firm to maintain a minimum cash balance. The bank may require the firm, for example, to keep the leverage ratio below a certain level. The firm may require the firm to keep the dividend payout ratio below a certain level. For example, the firm cannot pay more than 40% of earnings. Okay? They want to make sure that the firm will not default. Okay? So firms may breach, in practice, may breach these covenants, and then at the end of the year, they manipulate the reports in order to fool the creditors and tell them, okay, we didn't breach the covenants. So during the year, they may breach the covenants, and by the end of the year, when they prepare the statements, they manipulate them in order to fool the creditors into believing that they didn't breach anything. A management change, maybe the new manager may try to manipulate the reports in order to prove himself or herself, or maybe the change was because of the old management misbehavior or something like that. An auditor change also, this is a flash. Again, I would like to remind you, these things may be observed for normal reasons, not necessarily because of manipulation, okay? But we are talking about situations where manipulation is very tempting. But that doesn't mean that we must find manipulation. We may find, we may not find, okay? It depends. Management bonuses or rewards are tied to earnings. Management is repricing executive stock options when the options are can be repriced. When also a weak governance structure, we are talking about the monitoring level inside the firm. If the monitoring level is weak, in this case, management are free to do whatever they want. Regulatory ratio requirements are likely to be violated. For example, in the banking industry, usually the Reserve Bank of each country, they require each bank to keep, for example, minimum capital ratio or capital adequacy ratio. In this case, banks may, for example, violate the requirements but try to manipulate the reports in order to appear as if they have been adhering to the requirements, okay? Transactions are with related parties rather than at arm's length. This is a very important point because firms sometimes they do fake sales transactions or transactions with related very close firms or related parties in order to boost their revenues and earnings. And these are fake transactions or transactions that are with very close firms. How to explain this point? We should have when you evaluate the sales and revenues and transactions of the firm, you should make sure that its sales are made with diverse and broad customers, rather than with single or very closely related parties. Okay? If this is the case, this is not good, this is not healthy. Okay? It is possible that the firm might have a deal with the related company to do in between sales and purchases transactions between them in order to inflate the revenues and earnings. But these are not healthy transactions, okay? Special events such as union negotiations and proxy fights. Sometimes firms may manipulate the reports in order to soften or reduce the demands of labor unions. For example, maybe labor unions, maybe they try to negotiate with the firm to increase the salaries of their employees by a percentage equal to the increase in earnings or sales. In this case, the firm may try to reduce the growth in earnings intentionally in order to reduce the amount of the increase in the salaries of the employees, for example. Something like that, okay? the firm is in play as a takeover target. Takeover target means that this is the case when another firm is interested in our firm and is willing to buy it, take it over, to buy it, to acquire it. Okay? If this is the case, in this case, our firm might be, or there is a temptation to improve or manipulate the financial reports in order to sell the firm to the interested party at a high price. And usually these transactions, they normally, most of the time, they end with a disaster for the buyer. In practice and empirically, it has been proven that most of the acquisitions that happened in practice, they were like, how to say, usually the buyer or the acquirer, usually they overpay to the target. Maybe because they overestimated the potential synergy, or maybe because the target, they fooled the buyer by manipulating the reports to give them a false impression about their potential and profitability. So the buyer, they end, most of the time, the buyers usually they end overpaying to the target and they lose money. Okay? Who are the ultimate losers? Usually the ultimate losers are the shareholders of the acquirer, the buyers. And the ultimate winners most of the time usually are the shareholders of the target, the firm that's being bought. Okay? These are the ultimate winners. Sometimes firms may engage in exotic arrangements, such as structured off-balance sheet vehicles, in order to manipulate the reports. For example, the firm may have an off-balance sheet liability, but it doesn't appear in the balance sheet. That will make the balance sheet look better. Huh? There are also financial statement indicators that manipulation is more likely. For example, a change in accounting principles or estimates. You need to ask yourself why the change happened. Maybe it is for a genuine reason, but maybe it is because of earning manipulation. So you need to be very careful. An earnings surprise, you need to check if the surprise is real or not. A drop in profitability after a period of good profitability, maybe the drop is real, maybe the drop is because of the reversal property of manipulation. So we need to be very careful. Constant sales or falling sales, again, pay attention. Earnings growing faster than sales, this is a very important point. Normally, the growth rate in earnings should be almost similar to the growth rate in sales. If you find the growth rate in earnings greater than the growth rate in sales, this is a bad signal. There is something wrong. Okay? So the growth rate in earnings should be almost equal to the growth rate in sales. Otherwise, then we have something wrong here. Either because the performance of the firm is deteriorating, or maybe because of manipulation. You need to check. Okay? Very low earnings, again, could be for genuine reasons. Small or zero, actually this one is a typo. It should be a decrease in profit margins. And also a firm meets analyst earnings expectations, but just so differences in expenses for tax reporting and financial reporting. If the difference is big, then you need to worry. Financial reports are used for other purposes like tax reporting and union negotiations. Also, you need to be aware of these things. Accounting adjustments in the last quarter of the year, again, that could be a flashpoint. This is it. Any questions? How do you feel before we leave? How do you feel? Do you feel that you are gaining good knowledge? Yes? Huh? Okay, by the end of the semester, you will feel that you can do a comprehensive equity report from the scratch. Okay? You will see how lovely this unit is when we discuss the forecasting techniques. Okay? Okay, I will see you next week.
You have the forecast for N. Multiply the forecast in terms of multiplied by the calculation. That will give you the per share of 2023.
The payout ratio, if it's 50%.
The payout ratio for this one was around 70 something, 70%, right? Yeah, 70% something, okay? You multiply the payout ratio by the expected earning per share, that will give you the dividend per share up to the end of your horizon. Then you need to calculate the terminal value by the end of your horizon, and that is equal to dividend, the last year dividend, times 1 plus the growth rate. You use the GDP growth rate. And then you divide it by the difference between the dividend and the growth rate and the GDP. That will give you the terminal value by the end of your horizon. Then you discount it to the present and look at the other dividends within your horizon.
So we just need to apply this statement of earnings per share for the 70%.
So you expected the earning per share, and you multiply it by the payout ratio to get the dividend. And that, okay, that's fine. So is the residual earnings, I'm not sure about the calculations, but every year, okay, the return is equal to earnings divided by the lag book value. Then you take the difference between this and this, multiplied by the lag. This is the residual earnings, okay, you need to discount them. This is the sum. And this is the continued value. Okay, assume that your calculation is correct. The formula is put there. Okay, it's fine. Okay, take the average of the three. What is the market price of BHB in early January? 37. So what is the average value of here? Around 15, 16 something? Okay, if your calculations are correct, okay, you can say, for example, the company is overpriced, for example. Assuming that your calculations are correct. Okay?
This one is much larger than.
So what is the average price to earning ratio? What is the average price to earning ratio?
It's here.
You multiply it by the earning per share.
Because this 19 is different from
It's not a big deal if it is different. You take the average and convert it to this is what we need to worry about. The difference between the average and the market.
yeah, the average we get is quite different from the market price.
Yeah, this is what I'm talking about. There's a big difference. You need to look. Maybe your calculations are wrong, or maybe the market price is overpriced. So double check and make sure that you did your calculations properly. Okay? Wait a second, give me please. Show me this one. Show me the first sheet. Okay. So this is the continuing value. We took G9. G9 times 1 plus the growth rate divided by the difference between the third return and okay. Why it was so here, the calculation seems fine. Good. Maybe the growth rate after 5 years will be bigger than this one. We estimated this one out of conservatism, okay? Maybe because the growth rate, for example, let's see what we do with this one.
Yes, we use the GDP growth rate. I
Yeah,
think.
it's fine, but I'm telling you, maybe if you do further analysis and you may find like this high growth rate could be maintained for longer than 5 years. In this case, we need to take this into consideration. In the meantime, I will just mark the calculations you are assigned based on the steps rather than the accuracy. It's no problem.
Yes, because we use the earning growth rate as about 5% to
Yeah,
calculate
that's
the
fine.
rate.
Did you get this one correctly, the earning per share?
Yes, it's 1.2.
This
Yes,
is a correct figure, huh?
yes, it's a shows in the first page left.
Yes, okay, that's fine. Yeah, it should be fine. Assuming that you got all the numbers correct, it should be fine. Don't worry. Just benchmark the market price and say the market price is overpriced.
But
Every time to show the syllabus.
when I calculate this one, I find the website also shares the earning and shares the number of shares outstanding, and I divided by the earning last year by the number of shares, and it got the earning per share.
To get the earning per share.
It's not one. It's much bigger than this one.
Which one?
Earning per share.
Be careful, I'm telling you, if this one is wrong, all your calculations are wrong. So double check the earning per share, make sure that you get the starting point correctly.
This 1.2 is what the website directly shows us.
Go to the financial reports of the firm, double check it is the same. If it is not the same, take the one in the financial reports. This is more accurate, okay?
Okay, second.
Most okay. Take the financial reports of the June last year.
Okay, we will check it.
Yes.
Hi, when we put ourselves in groups, like if then someone else just randomly added into our group, then it shows an element that isn't attending.
That's why I give him 0 on Spark.
So
This is
fair
what the
enough,
Spark
we're
for.
allowed to do that. But don't we need a signature for the cover sheet of the assignment?
No. Just put your name, all of you, don't drop that guy, just keep his name.
Yep.
But on Spark, give him a score of 0. This is what the Spark for.
Yeah. Wait, what
Because
if
of the free riders, we don't need the free riders. Free riders should be punished.
What if he submits something that isn't ours?
Yeah,
to
for
come-
us.
yeah.
Without what?
like, you know how because he's still
He's
able
doing
to
the assignment on his own.
I don't know. We don't know if he even
Don't
exists.
worry, I will just mark the group assignment.
Okay.
Just give him a score of 0 on Spark and that will be fine.
All right.
If he submits something in his own name, I will not accept that.
All right. Thanks.
Okay?
Yeah.
Any other questions, guys? Fast and free is just the most popular ratios. If you go to Google, just put the most top 10 ratios and use them. That's it.
To get those, do we have to go through the past 2 years of reports?
Yes. You can find them in Yahoo Finance. You will find some summary balance sheet for income statement. That's it. You don't have to, the annual report is very huge. But just go to those compact statements reported in Yahoo Finance and use them in the analysis.
And do we use the diluted EPS for EPS?
The what?
On Yahoo Finance, there was a diluted earnings per share that came to 1.0.
Diluted.
Yeah. That came to 1.02. Do we use that as our earnings per share?
Normally in practice, analysts they calculate two values, diluted and the basic, and then they take the average.
So you calculate the
Yeah, just
basic
take,
from the...
use the basic, it should be fine. Okay?
Cool.
You can calculate two values and take the average, okay?
Yeah.
This most will. Yes, please. So you can write on this one and save and everything? Yep. What is this, what do you call this one? This is a notebook?
It's a application designed by Microsoft.
Okay. So what is your question?
Actually, I didn't hear this. Which one is manipulation?
These two are types of manipulation, and these two are types of accounting policy, a matter of accounting policy. So make sure that you do not confuse them together.
Yep.
Okay. All the best.
One more question.
Yes.
One more question for the tutorial. From last week tutorial, we have one question that they ask you to reformulate the statement of comprehensive income from the statement of shareholder equity and the statement of balance sheet. But what is here? How to reformulate the statement of comprehensive income?
The solution is available in LMS. Did you see the solution in LMS?
Yes, but the stuff is like
Just to start with the beginning balance. Yeah. This is the beginning balance. If there is something dividends payable, blah, 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 you add it to the beginning balance. If there is, for example, preferred equity, you remove it. There is nothing like that, so you keep the beginning balance as is. Then you combine the transactions with shareholders together and comprehensive income items together.
so that's the
This and this. These are share transactions with shareholders. You calculate the negative deal.
yep.
Okay, negative deal.
Yes.
Here, this is from how much received by the firm from the perspective of the firm, rather than how much paid to the shareholders.
So you pay to the shareholders.
Just take the sum,
Yep.
positive, negative, take the sum, this plus this one, this is negative, plus this one, this is negative.
Yep.
That will give you how much added to the equity.
Yep.
Then these two together under a broad title called comprehensive income. So comprehensive income equals the net income and this one. And this is it, just the structure. Look at the solution in LMS, you'll understand what's going on. Just organize it in a very compact way.
It's like you first adjust the statement of the income statement, and you get like
Later on, later on, when you reformulate the income statement, when you reformulate the income statement,
But they didn't give you the income statement. They just give you the balance sheet and payment.
yeah.
So that's
Hello, how are you? I'm fine. Yourself?
Good, thanks.
Come here, mister. Let me show you the question you are talking about coming from.
as long as you can get like the operating income after tax, you can get like the comprehensive income from
Okay, that's
passing
fine. That's
D.
fine. I will explain to you.
Yep.
This is the last question in the workshop, right?
Yep.
So here, what was the question? Can you give me the number?
The question is asking you.
10.6. Check, please.
The number is 10.6.
Okay, this is the balance sheet, very easy to deal with. Then we reformulate the equity statement. It is the same items here given to you.
Yep.
Here we group the transactions with shareholders together.
Yep.
This is the net. This plus this plus this. This is the net. And comprehensive income items together. This is the comprehensive income. This plus this is the comprehensive income. The only things when we reformulate the balance sheet, the income statement, the only thing we do, or two things we need to do. First, we need to reformulate it such that operating items together, financial expenses together, and any gain or loss that is usually reported under the equity section should be also recognized there, because we need to calculate the comprehensive income. This is the comprehensive income.
Oh, so this is the comprehensive income.
Yeah, so we start from the bottom. Comprehensive income is equal to net income plus any gains or losses that are usually reported in the equity section.
Yep.
Okay? So this is the comprehensive income, calculated above, 518.
So we use
And
like
this-
the bottom up method.
Yeah, the bottom up.
Up method.
Yeah, so this is interest expense, this is interest income, this is the net interest expense, this is the tax benefit, and this is the after-tax net interest expense. On top of that, we have the unrealized gain on debt investment. This one is reported under the equity section. From this equity section, this one, 50. It is on debt investment, so it is a financial
Activity.
item, okay?
Yep.
It is a gain rather than an expense. So this is an expense, and this is a gain. We take the net. The net is 4. So this 4 is net financial expense.
Oh, fine.
Net financial expense. Note that this one is already on after-tax basis. We do not need to worry about the tax treatment. So we take the net between this and this. This is 4. When you add this one to the comprehensive income, that will give you the operating income after tax. The question also gives you revenue. The difference between revenue and this one is equal to operating expenses, including taxes.
Oh, so we can get like the comprehensive income at first place. So,
Yeah, the comprehensive income can be calculated here. It is equal to the net income from the income statement,
and
plus
unrealized
all
gain.
gains and losses that are usually reported in the equity section.
Oh, good.
Okay.
Yeah, oh, good. One more question. For the first part, is that like the operating income after tax is the same concept as net financial expense after tax? Is this two is the same?
What do you mean there, Hassan?
Because like the question asked me to calculate the two things, but I think it turned out to be the same.
No, not financial expense.
My tutor says
Operate-
it's the same.
Net
Operate
financial expense after tax
is
is
the
equal to, who's your tutor?
Zach, Z-I.
Are you sure he said something like this?
Yeah,
No.
so how to calculate
Operating,
like the net?
operating income after tax is equal to net income plus after tax net financial expense.
After tax?
This
net
is the bottom
financial
up. This is the bottom up.
method. Yeah. So which part is net financial expense after tax? It's like if you do
This is-
a bottom.
Oh my
bottom.
gosh.
Is that right?
Did Zach say so? Are you sure he said something like this?
Yep.
Maybe you misunderstood him, man.
Yeah, that's maybe.
This is, just go to the solution. Use the formal solution in LMS, you'll be fine.
Okay, I'll check
Okay?
the solution first.
go to the solution in LMS, you'll be fine. After tax, net interest expense after tax is equal to the interest expense times 1 minus the tax rate.
Yep.
So this is the after tax net interest expense. We add it to the net income, that will give us the operating income after tax. This is the bottom-up approach. But this is the bottom-up approach, we discussed it last week. Yeah.
So,
Do you remember what we did here? This is the method here. I explained it to you last week.
so like the net financial expenses here.
Yeah, this is the net financial expense after tax.
Yeah, so you do bottom up plus, so you
Plus net income, that will
yeah.
give you the after-tax operating income. This is the bottom-up. The top-down, we make the breakdown from the beginning, from revenues down to this bottom. We get the same answer.
Yep. Okay.
Okay?
Okay. I'll check the solution. Yep.
Use the solution elements will be fine.
Okay. Thank you.
This website shows us the vertical share one.
So we got two.
But when I go through the detailed data, and here it shows net income available permanent and it is 8.8. And another figure is the share outstanding. And when I use this one to divide it by this one, we got earning per share of 3. And if
We leave you good one. Send me an email.
Yeah,
because
we
I
can do
want
that.
to
Yeah, thank you.
Publish all my answers to you students' queries and elements so that everyone will benefit from it. Okay?
because if we change this to 3, that was 44, and it's more close to the share price today. If we change it to 3, and we got a very
Where is the earning per share we should be?
So which one?
And the number of shares outstanding.
Okay, yeah. We'll see how it goes. Maybe they tend to be quiet. Yeah. Maybe let
Trailing 12 months.
yeah.
Trailing 12 months.
Or maybe have a, like a question time after each session or yeah. See how it goes. So this one, the first one?
Yeah.
Yeah.
So make sure that they are at the same point in time. Now here,
So any video or any audio? Yeah. So that's the volume. I'll put it right here. But if it's too loud, you can just go up and down.
use the earning per share from the annual report of the firm.
Yes,
Go
and
to the annual reports of the firm and use it from there.
Okay.
income statement for last year shows us the
Oh, okay.
net income is here. And
Yeah, that's the thing.
divided by share outstanding today. Got
Not today, at that time. You should use at that time, the same point in time, in June 2018.
That's the one, isn't it?
That's the one?
Yeah.
You can find it.
I haven't found it before.
That's your Premiere.
Be careful.
Yeah.
Pro.
Yep.
So cool. Yeah, some students have Premiere.
Yeah.
I hope they. Yeah, some
Well, there's another one I'll talk about, which is Rush.
I've never heard of that.
Yeah, it's a new one, real easy to use.
Oh, cool.
So, yeah, I'll talk about that. We can bring it up on the screen and show them.
So I will